While it's been a good year for Peregrine Capital, it's been a very difficult year for the world as a whole. We're dealing with our first major war in a very, very long time. And also for the first time in around a decade or so, the world is having to face increased interest rates pretty much everywhere, developed markets and emerging markets. This has caused an extremely difficult environment for global markets, and it's been a tough year for most investors to protect investor capital and generate strong returns. To give you an idea as to how tough things have been, as at the end of September, the JSE All-Share Index is down by more than 10%, with the multi-asset high equity category down about 7%. Globally, things have been much tougher. The S&P 500 is down about 25% year to date, with the Nasdaq down 33% as at the end of September. Normally in these kind of times, bonds provide some protection. But because of the high inflation and the negative real rates provided by bonds as at the start of the year, the picture has been as bad for bonds, with the Bloomberg Global Bond Index down about 20% year to date, making it one of the worst years for bonds in the last 100 years. So what's caused this? Firstly, we had a world for the last decade that was aggressively stimulated by very low interest rates in the entire developed world. While this was certainly necessary in a time like COVID where there was a massive demand shock, my belief is that the central bankers and governments way overstayed their welcome and kept stimulating for far too long. This caused excess demand coming out of COVID, and due to some supply limitations, economies just overheated, leading to massive inflation caused by the high demand and lack of supply. Now we've got the structural inflation problem to solve. How do governments and central banks typically solve this? You've got to increase interest rates significantly. And the Fed has led the way this year with some very significant interest rate hikes. Given this very difficult backdrop, we're pleased that our funds have delivered high single-digit returns year to date for investors. How did we achieve this? Firstly, we identified early on in the year that the risk to global markets had increased significantly due to higher inflation and likely significantly increased interest rates. As a boutique-style asset management firm, we are much more flexible running a lower AUM than some of the very large long-only managers. This gives us the flexibility to rapidly change portfolio positioning when the global environment changes. We reduced especially offshore equity exposure and decided that it's an appropriate time to run lower net market exposure and higher cash balances, giving us the flexibility to take advantage of individual opportunities as we saw them. Our team also applied our minds to find individual stocks and businesses that will be less impacted by the global economic slowdown, while trying to really identify companies that will actually specifically benefit from the current set of circumstances that the world is facing. We believe that the global economy is likely in for a difficult 12 to 18 months period. Once inflation gets above 5%, it's historically been very hard to get it back down. So it's not at all clear to me that central bankers will easily get inflation down to the desired level of 2%. Additionally, we also know that interest rate hikes take 6 to 12 months to have their full negative impact on economic growth. This means that for the balance of 2022 and into 2023, we'll likely almost certainly face a slowing economy due to the rate hikes we've seen so far from the Fed, ECB, BOE, and other countries. In this environment, we remain resolutely focused to generate strong returns for investors. We're sitting on meaningful cash balances in our funds, allowing us to take advantage of opportunities into the market sell-off. For us, balancing the conservatism to protect investor capital in this environment, while also being on the front foot and taking advantage of opportunities when they come, is a key focus and what we're applying our minds to. So from all I've said so far, you can see that it's certainly been an interesting year navigating markets and repositioning portfolios to ensure that we are well positioned for what the market is throwing at us. You'll find some additional commentary in the letter that covers some of what we've done year to date and also our prospects on the year ahead. It's really a great time right now to be managing a hedge fund. We've got a wide toolkit available to generate returns for investors under various circumstances, and I can tell you that that toolkit is being put to its full use right now to generate great absolute returns. Thank you.